All right, folks. Today is October 29th, 2019. You're looking at the market close. The Dow, S&P 500 were down about 0.1%. NASDAQ was down 0.6%. And small caps were up 0.3%. So if you notice, I always focus on the small caps. Small caps are, 8 to 10% below their all-time highs from last year. I do believe they're going to end the year at a new all-time high. I still believe they're going to end the year at a new all-time high. Tomorrow is Wednesday. We're waiting for the Fed to decide if they're going to lower interest rates or keep them the same. I'm going to tell you now, they're going to lower interest rates. They've been putting too much money in the system to not lower interest rates because the system's getting desperate. The markets are wanting more money because they need more liquidity out there for investments. So let's look at some charts. So let's look at the semiconductors, which the semiconductors, they're closely correlated to the tech sector. You see SMH semiconductors, they were down 0.7%. You see the NASDAQ was down 0.6%. So all of that makes sense. We're looking at the weekly chart, but let's look at the daily chart. Okay, so for the SMH, we finished today about even where yesterday started. So we'll keep an eye on that. We do expect the SMH to start correcting some. It's getting pretty far away from its 20-day moving average, which is the green graph line. Let's look at some of the other charts. Let's look at SPY or the S&P 500. S&P 500, you see the 20-day moving average is still above the 50-day moving average. Both of those are still above the 200-day moving average. SPY didn't look too bad today, but if you look at the daily, the bar graph is getting a little far away from the 20-day moving average. So one thing I've learned this year, looking at these charts, the charts won't get too far. The daily charts, the daily bar graph, they won't get too far away from the 20-day moving average. So the 20-day moving average is very important. Right now, we're looking at what? 296, 304, what is that? 8 divided by 3, 2.5%, 3% above the 20-day moving average. It could probably still go a little bit above that before it starts correcting. But I do anticipate it to start correcting over the next couple of weeks before it makes another high, if it does. If not, it's going to correct 6 to 8% through the middle of November and then head up to all-time highs through the end of the year. So remember, I keep stressing there's going to be a pullback. And every time I say there's going to be a pullback, there's normally a pullback anywhere between 4 and 8%. This one I think is going to be between 6 and 8%. So hopefully we can identify the bottom of that pullback, and then we'll jump in long, and we'll go long on small caps and Harbor Capital. Let's look at the Qs. QQQ. Okay. So here's one thing that I have been learning this year. You see that QQQ, the chart for the day, the bar chart for the day. It finished below the low of yesterday. Well, it was a breakup. There's a gap there, so it filled part of the gap. If it comes down to, what is this, about 193-ish? No. If it comes down to about 195, it will fill the rest of the gap. So, if it fills the rest of the gap, it may go up some. It's probably pretty likely that it's going to go down 4 to 6% before going back up to meet a new all-time high. Let's look at the Dow Jones, DJI. DJI was about flat. We're still waiting for Dow Jones to hit a new all-time high. It is above its 20-day moving average. The graph is above its 20-day moving average. 20 days above the 50-day moving average. 50-day moving average is above the 200-day moving average. It all is headed positive. We do expect a correction, though. Remember, I keep saying we do expect a correction. I could be wrong, but we're not going to worry about if I'm wrong. We're just going to do our best to try to forecast what's going to happen. Let's look at IWM. Small caps. Small caps are coming up nicely. They're what? Five. They're about 3.5% above their 20-day moving average. I do like their 20-day moving average moving. It's about to get above their 50-day moving average. Remember, 20-day moving average, 50-day moving average. If they go up and they touch that 200-day moving average, they cross the 200-day moving average from underneath. That is a good 4% gain in the IWM, which is the small caps. I stress the small caps because I think the small caps are going to make a new all-time high, and they got about an 8 to 10% run from where they are right now to do that. If the markets drop, small caps makes a new all-time high after dropping 6 to 8%. They have about a 14 to an 18% gain that they'll have to make up by the end of the year to make all-time highs. So we're keeping a close eye on small caps. That's one area we can really gain on and possibly beat out a lot of the other markets by focusing on the small caps. IWM. Let's look at financials. XLF. All right, so we're looking at the financials. All right, we're looking at the financials. Financials were up slightly today. They're up nicely from their 20-day moving average. So what is that? 20-day moving average is like almost a 28. They're at a 28 points. We might as well say 29. What's the difference? One. Still, what's that? About 3%, I'm guessing. About a 3% difference. They are getting kind of extended from the 20-day moving average, but I do expect all the markets to correct the next 2 or 3 weeks and then finish the year at new all-time highs. With that being said, the Fed's coming out tomorrow. The markets will probably go up, down, sideways 1,000 times tomorrow. I'm pretty sure the Fed is going to cut 0.25% off the interest rates. They'll probably cut 0.25% off of the interest rates in December. Actually, they'll probably cut all next year. I think Donald Trump is going to get reelected. They'll probably cut the year after that. At some point, they already started quantitative easing unofficially. At some point, they're going to officially start quantitative easing, and they're going to be dumping trillions of dollars back into the system to keep it alive or to revive it, or both. So, even though we might not finish with a very high return for this year, I did that on purpose because I've been pretty conservative. If I take the average for the last couple of years, it'll probably be closer to like a 15 or 20% at the end of this year. Everybody else, even if they finish with a 35% return, they'll finish at about minus 20 plus 35, like a 7% return at best on average for the last couple of years. We should be closer to a 15% return over the last couple of years, even though they beat us out so bad. So I'm not worried about that. I'm more worried about long term. Thanks for being patient. Later.